Want to level up one more level about syndication?
Let's go.
Because
it's not called the Famously Hot Group for no reason, Dina.
I know. I think this group's ready to go up. I know. I got that feeling already.
Look, you know the law of what is it? The law of 7 or whatever. Like you guys know me. I know Dina. Dina knows Mike. Mike knows the king of Saudi Arabia. So
hey, listen, look at that, right?
You're welcome.
Like them rent checks, 1st to the 15th. Life and starlight, count my lucky stars, I'm all right. Things are looking up, my desires are on sight. Gotta keep grinding, make sure that it lasts forever, not only one night.
Hey everybody, what's up? It's Noah from Cola REI, Famously Hot Real Estate Group. And we're back at it like bad habits. Hey, what kind of investor are you? Are you an active investor? Are you highly active? Or are you more passive? Like, are you fixing and flipping? Are you wholesaling? Are you a real estate agent who earns their income through listing houses? Are you a contractor? Do you have a small business that generates income somehow through real estate? I'm so excited for you. Just stay tuned. I'm gonna tell you about something really cool that we're doing tomorrow. And on the other side of that, we've got the active income investors, fix, flip, wholesale agents. We've got the passive investor. Are you the type of person who loves the idea of making money with your money? Are you looking to buy investment properties to keep as rentals, or Airbnbs, or short-term to corporate travelers? Or maybe you're like, hey, I just want to put my money to work at great rates of return through private money lending or tax liens. Or maybe you're a business owner, but you don't necessarily like do a lot of work within your business. You have other people that are doing it for you, bringing income to you, right? So whether you're an active investor or a passive investor, tomorrow night, 6 p.m., November 3rd, we're holding a networking event. It's the re-up, and we're doing it for 3 hours. We're just getting together, networking, where active investors, active business owners can meet passive investors and people that want to put their money to work, right? Give you a great example. We just closed on a flip. We made active income flipping the property. The private money lender who lent on the deal, they got a great rate of return without really having to do much. And we brought in all kinds of people that made money on the deal too, agents, contractors. So where else can we all get together and re-up our networking, re-up our connections? I'll put the details down here for you. And I'm really excited about today because I have such a special guest, someone near and dear to my heart, who's going to be talking about active income, but also I'm really intrigued, you guys, on what she's been putting together for passive income investors. See, a lot of people think that passive income in real estate is owning rental properties and being a landlord, but what if there was a better way to do it? And what if instead of you trying to put your money to work and figuring out, gosh, where should I invest? What state should I be in? What neighborhood? What property? What if you had an amazing team that did all the due diligence and it wasn't a rinky-dink house? What if it was something really cooler, like an apartment building, right? To diversify your risk. So I'm gonna let Dina explain exactly what she's been up to and how someone could passively invest in real estate without really having to be too involved. So without further ado, I'm gonna give a big Cola REI welcome to my dear friend, real estate investor. You guys are gonna love her. She's invested all over the country, different countries, Canada, Costa Rica, right? And so she's bringing a lot of knowledge to this group. I'm so happy. I can't believe she did it, but she's here with us. She said yes. So without further ado, let's bring on Dina Buchanan. Dina, are you there?
I am, Noah. How are you?
Hey, I'm doing great. How are you?
Doing fantastic. Thanks for having me. This is so fun.
I know this group is really excited for a couple of reasons, right? Like passive. I meet so many people that are like, hey, look, I want to get into the business, Noah. Right. Can I just, for lack of just be straightforward with you, Dina, people are like, hey, can I just give you my money?
Right.
And invest it. And sometimes we can work that out with like passive income in the form of like private money lending.
Mm-hmm.
But lots of times, I only want to take on so many projects at a time, and so people are looking for opportunities to put their money to work. And I saw what you were doing. I was like, oh my gosh, I have to get Dina on our show, the big show.
Oh yeah.
To talk about this, right? So before we get into that, like, tell us a little bit about like your background with real estate, and because I know you really well, and people all
Right.
over the country know Dina Buchanan, but you know, to someone who's sitting in Columbia, South Carolina, like, who is this person?
Yeah,
right?
where did you come from? So, you know, my husband Eric and I started out a lot like you and Christy did. You know, we got some education, which I think is always important, and to learn what you're doing. And we started doing single family flips, buy, fix, flip, and buy, fix, refinance, hold. And it was probably we were about 3 years in, we got our first apartment building, and it was a 27 unit. And I always tell people like that was like the intoxication right there. It was like, wow, we started to see how we could diversify cash flow with when you have, you know, 27 doors under one roof for one price, and you start looking at percentages of like, wow, if I've got one vacancy, it's not the end of the world. Whereas a single family home, Eric and I were like, oh, wow, it's feast or famine if this is empty or full, you know, and how does that affect our cash flow?
So hold on. So you're telling me it's almost riskier to go with one small single family house than it is an apartment building?
Well,
from an income standpoint,
if you're doing the math from an income standpoint, yeah, because if you have, let's say you've got 12 doors, or let's say 20 doors, and maybe it was $1.5 million, right? To buy that. It depends on what market you're in too, because we always buy everything wholesale, even if it's an apartment building. But a single family home, if it's, you know, $150,000, $200,000, that's $4 million for 20 doors. So when you look at just the cost in, it's a lot different. And then when you're looking at the return percentages, rental wise, again, we stick with Class B communities pretty much. So we're going to be right in line with what a single family home would rent for square footage wise, you know, dollar for dollar, price per square foot. So if you're looking at it from that perspective, it's just a no-brainer.
So you started it out because a lot of people get into real estate because they like the idea of being able to make a large amount of money in a relatively short amount of time, right? Through flipping or wholesaling, right? Active income strategies.
And we did that too.
And then at some point, and I feel like I'm kind of at that point now where like we have rental properties and stuff, right? But now I'm kind of at the point where I'm like, I want to do absolutely nothing and grow. I just want to be so I'm passive aggressive, as we like to call it, right?
You just want to have your money work instead of you, so that you could go do fun things with your family, and not
that's kind of where you're at now too, I imagine, with the business.
For sure. Yeah. And one of the things that really hit us, where we really started to see the impact of the type of income you're just talking about, was when we got into a syndication. So we actually invested, I want to say it was probably 2007, 2008, right about the time we did the apartment community, we got invited into a syndication, which a syndication, just for everybody's knowledge, it sounds like a big, scary word. It's really not. It's a group of investors that put their money together to buy a bigger asset, like a multifamily apartment building or a piece of land or commercial, you know, office buildings, etc. So we participated in a syndication, and when we saw the returns, Noah, that we got back, we were just like, okay, wait a minute. All we did was put our money in, and we get monthly interest only payments every single month. And then, you know, when they did a cash out refinance, we got another chunk of change back. And then at the end, we got some back. And here's the cool part that we really didn't realize was we got tax advantages from it, because we actually had a percentage of equity in it, which is ownership. So we got to have the same tax advantages as we would on some of our rental properties that we owned, but we didn't have to do anything. Like, we just put the money in, and it was like, whoa, this is so cool.
Yeah. What do we call those? What type of moments are those?
Aha moments.
Aha moments. Yeah.
Right?
Boom moments.
Or boom moments, right? You know, I mean, boom shakalaka, what I used to always say. But, you know, so that was really kind of what started. And, you know, Lori Santorelli, my business partner and dear friend of both of ours, we were, you know, talking about like, hey, we really want to do more of these. And so we started looking, her and her husband and Eric and I, we would do investments and look for investments together. And we thought, gosh, there's some really cool opportunities out there. Maybe we should be the ones creating the syndications, because we can align with people that we like, know, and trust, that we've got business relationships with, that are in the same mindset as we are, as far as where we would pick and what we would do.
Yeah.
And Lori's husband was a big driver of this because he was very into studying what, economically, what's happening to investors that are investing in properties that are in markets that have a lot of climate risk,
Now, okay. So now, all right, now we're talking, because this is what really spiked my interest.
Yeah.
Growing up on the coastal areas of Florida,
Right.
And seeing hurricane, having a lot of family, or not, I call them family, but very close friends
For
in
sure. Chosen
South
family.
Texas and Louisiana,
Mm-hmm.
and just wondering about the real estate market and seeing people put a lot of hard work into their products and their flips, and then just being like devastated. And I kept thinking, gosh, like, what I wish there was a way where they could invest in areas that may not be as exposed to what's going on in the world right now from a climate standpoint.
Right. And we call those, for our business, climate resilient markets. So
climate resilient markets.
Yeah. And what we mean by that is, it doesn't mean like I live in Windermere, Florida, Orlando, for those of you that know that market pretty well. So I'm in Central Florida. So it's a lot different than growing up on the beach, right?
Right.
As far as hurricanes.
3-4 hours can make a big difference.
For sure. And it's not like we don't have any inclement weather in Orlando, or we don't get hurricanes that come through, but it's a whole lot less than getting pummeled the way the coast does. So if we looked at the difference, and we did, the four of us did, we said, hey, listen, what's the impact over time economically for us, our investors, the risk? And we started to see, wow, this is significant, because like it or not, the great debate of our generation, right? Yeah. This isn't, when we say climate resilient and climate risk, we're not talking about politics or politically wherever everybody stands on that. What we're saying is, just do the math. If you're going into these markets, there's some things that are happening all over the country. I mean, California, even Lori and her husband live in north of Denver in Evergreen, Colorado. And there are people that they know, neighbors that are a couple miles up higher than them elevation, are getting their insurance dropped. Why? Because it's a risk. And it's happening also, it's trickling into commercial. And so we started to look at this and say, well, wait a minute, if somebody's going to do a syndication, which we do, and you've got investors in there like us ourselves and everybody else that are in there for 5 years, 7 years, some people do it for 10. What's going to happen with these weather patterns that are, like it or not, it's happening, regardless of how you think it's caused or whatever.
Can't argue the fact that there's hurricanes, and
it is what it is, right?
Flooding, and even in the single family houses that we're flipping, I don't remember ever installing so many gutters and French drains and sealing basements as much as
never in our experience either. It's kind of crazy. So when we were looking, especially these big syndications, this is what really sparked our interest. So Mike is our #1 risk analyst for PCRP Group for our business.
So can you talk, is Mike, because this is important, right? If someone's picking a team to work with,
for sure,
they if someone's picking okay, I'm a private money lender and I'm going to lend my money, you're not just lending on the deal, you're lending on the team that's going to be finishing that project. Or identifying that project. And so I love your team. You got the James Bond, you're like the Avengers of syndication, I think. Right. So what a little bit of background on your team is important.
So Mike is Lori's husband. He has been, for probably the last 2-3 decades, he's one of the top 3 economic analysts in the world. And he was literally just over in Saudi Arabia talking to the king, and they're talking about economically, what are the issues that are going on worldwide, and one of them is the climate extremes, right? Or what's happening, weather extremes, severe weather patterns, or whatever you want to call them. And he has done a lot of work with ESG, economic social governance, and studied it. And this is what was really powerful for Lori and I. This was one, you want to talk about aha moment, Maxwell House moment, wake up moment, was BlackRock and State Street Capital and other businesses like that are looking at not just what bigger syndication groups are wanting to finance right now, but they're looking at their whole portfolio. And they're saying, hey, if this group of people are in these markets and they've got this many developments, this many syndications, and they're in very climate risk type markets,
yeah,
they're probably not going to get financing.
Wow.
They're actually rewriting it into their contracts, their underwriting. And the reason why this is really happening to a quicker degree and what sped it up is the insurance industry. Like I just said, like there are companies that are dropping individual homeowners policies in certain areas. In other words, they won't insure because how do insurance companies make money? Right? Through their premiums. Well, when the cost of insurance is outweighing the profitability, I mean, they can't even break even in some markets. So they're just not going there, which means they're either A, not going to insure there, or B, you'll get a company that will, and it's got the monopoly. So that means the prices are going to be ridiculously higher. Huh. I was talking to an investor yesterday in our group who is in Miami, great guy, has been, doing his own thing for probably 12 years. And he was saying emphatically, he goes, you guys, this is like, I'm so excited to invest with you guys and be a part of your projects, because he said he's already seeing huge hikes on some of the deals that he's looked at. And it's making the numbers, I mean, just skewed. And can you imagine being in one of those deals and then getting the hikes?
Right.
And then what happens to the investors in those deals?
And then having to wait that long and have your money tied up and due.
Yeah. And it just felt like a little beyond the risk that we wanted for ourselves. And we thought, there's probably other people that feel that way too. The other thing we do is when we go in, we try to reduce our carbon footprint. So we love multifamily.
Okay. That was my next question. Like, it's you have the climate,
the climate
awareness
markets, right?
Awareness, and then
one of the other really, and again, there are things that we call win-win, right? It's doing good while doing well, right? So we're going to be at a better advantage for our investors and our team if we can do these climate resilient markets and apply the principles that we all know from investing is when we're upgrading our apartment communities, why not make them energy efficient? It's going to make the tenants happier. It's going to give the sponsors much better tax advantages, which means we pass that profit along to our investors that are in the deal, and everybody wins. People stay longer, as you know, when tenants love where they live and they know they've got responsible landlords, right? They're like, oh my gosh, like and property management's good. Yeah, there's no reason to move. So that's really another thing is the municipalities. Like, so if you've got a Class B community, and one of the reasons we stick primarily in Class B is because we know as market downturns come, Class A people move into Class B, and Class B is usually in a desired area. They're just 10 to 20 years old. For those of you that don't know what we mean by Class A is 10 years and newer. Class B is 10 to 20 years, and Class C would be over 20 years, like 20 to 30. And Class D would just be something that needs tremendous repair. It would be like those houses that zombie properties kind of thing, it'd be along those lines. So we stick in that class because it's got location, and it's really going to be that renovation that you upgrade. It's that house that needs to just get a little bit more of those, fluff and buff type.
So it's the same. So same thing. So you go in, you add value.
Yeah.
Increase the value by making repairs and updating, making the energy efficient.
Absolutely. Upgrades. It's crazy. I'm sure you've seen that, like what you were just saying, like when you're sealing basements and you're putting in gutters and everything, all those things that we do, you probably have seen tax advantages on. Like those are things that's like the government is saying, hey, this is great. This works. This is going to help everybody. Yeah. And it's going to make a greater, a nicer place to live for somebody. And it's going to help the environment, create more jobs,
So a person could, with syndications, because it's so sexy. With obviously due diligence is key, right? Align yourself with a good team.
Absolutely.
A person could have great passive income, while at the same time, great tax benefits.
Exactly.
As well, and sleep peacefully at night because they're not the ones that are getting the phone call if there's a leaky toilet or whatever. Correct. Right?
Yeah. And if you want to level it up one more level, about syndications.
Let's go.
because
it's not called the Famously Hot Group for no reason, Dina.
I know. I think this group's
All right.
ready to go up. I know. I got that feeling already.
Look, you know the law of what is it? The law of 7 or whatever. Like,
Yep.
like you guys know me. I know Dina. Dina knows Mike. Mike knows the King of Saudi Arabia. So, boom.
Hey, listen, look at that, right?
You're welcome. Yeah. All right, so let's next level. What do we got?
Next level is how quickly can an investor duplicate their money, right? This is a big deal because, you know, like it or not, we're at a point where we're printing a lot of money.
Mm-hmm.
And again, we're not judging good, bad, right, wrong. It's just something that's happening. And so the more money that's printed, and a lot has already been printed, like from March of 2020 to October 2020, it was like $4 trillion were printed, like more than the previous 50 years.
Yeah.
So every time more money gets printed, inflation, right? It's not the inflation isn't the cost of goods going up as much as it is the value of money going down. So it takes more dollars to retire. It takes more dollars to send your kids to college or pay for life. So the faster we can duplicate our money, the more financially independent we can always be. And so a syndication allows investors to do that, because if you look at something like the rule of 72, when you take 72 and you divide it by the interest rate a person's currently getting on their money, if it's 6%, that means it's going to take, and that person has $100,000 in that account, whether it be in a retirement account or a deal, it's going to take 12 years for that money to double. So imagine being in a syndication where your internal rate of return is something like 16, 17, because that's where we focus.
That's your goal.
That or higher. That's going to make it duplicate every 2.8 to 3 years. So that means the money can double quicker. So if an investor is looking at it from that perspective, their money can make more money quicker. So they can retire quicker. They can, you know, they can retire early. They can retire with, maybe they want a house in Italy like us, like maybe something like that, they have a much better probability of, living their life the way they want instead of the way they have to.
More money, more options.
That's right. That's right.
Man. So I got your website down there scrolling across the screen. Is that right? The PCR Group? Is that you guys?
PCRPgroup.com. Yeah. We do a lot of education on this. I'm creating a whole webinar education series that we should have out in the next couple of weeks. It's all complimentary. So anybody that's part of this group, please come sign up, join up. And you'll
you
get
got some
all
good
the
resources. I downloaded it. And one of the things I thought was really cool is you have like this guide that explains more or less active income strategies and passive income to help people kind of determine where they should put their energy and focus. So there's a lot of people who they might not maybe they have a great career, they have a great job, and they're like, hey, look, I make great money. Like, I don't want to be a house flipper. Like, I have no desire to do that, but I understand the power of real estate and how to leverage and the tax benefits. There's answers for you too. There's strategies for you too. And we're talking about one here today. So
we have a lot of investors that have a career that they love. And I think that's great. You should always do what you love. Yeah. And they just want their money to go to work for them. They're smart. The smart people are very smart people, right? Very smart people know, hey, it's one thing to make a lot. It's another thing to have the money make a lot, right? And create more.
Love it. Hey, Dina, one last question for you. And we appreciate your time and everything. When Dina Buchanan pulls up to a real estate closing and it's a good one, right? Big check, right? Yeah. What song is playing on the radio? What's like your go-to I'm crushing it today jam?
Oh my gosh. I
have a feeling I know the song, but
I don't know. I've changed it up,
Have you?
Well, my son, when no one knows this, my son, he's Mr. Personality. So he used to love the song Uptown Funk.
Okay.
And so that was his jam, right? So he'd get in the car and he'd be like, Mom, play Bruno Mars or play the funk song, because he was like 5 or 6 or 7 when it was out. But yeah, so that one always comes to mind when I think of it, if that's the one you were thinking of.
Yeah, it was. It
was. It? Yeah. And then my daughter introduced me to Head and Heart, which is like bum bum ba dum bum 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 ba da. And it's so funny because every time we hear that song, you know, she's like, we got it associated now with deals and business opportunities, and we celebrate, you know, everything that happens, you know, in our businesses. And now that she's 17, she's so interested in everything that our business is doing. And I mean, they were always interested in real estate, but she's really interested in what Lori and I are doing, because Lori and I really lead the business. Mike and Eric are definitely advisors in our team for sure, but it's definitely women-owned business. So she's so excited about that.
Awesome. Can't wait to see what our kids do with all this stuff. Hopefully they're picking something up. I don't know.
I think so. They'll probably all get together and go, man, our parents.
Hopefully they don't just sell it all, little brats. You know what I mean? When they're long gone, you're like, hey, I worked so hard for this. What are you doing? I'm gonna haunt you. No. That's right. So, all right, cool. Dina, hang out. I want to ask you some more questions, but we really appreciate you. And if anyone, you know, I don't just bring people on for the heck of it. Like, this is a ton of value. Go to our website, check it out, give them a call. You can email me too. My email's on there, or my phone, my cell phone, my Calendly link. You can set up a call, and I'm happy to sit with you guys for 15, 30 minutes, and we can chat about it, and you can learn some things. All right, cool. Thanks, Dina. You're welcome. Right, thanks for having me. Yep.
Rings on the front grill, raised a couple mil so I can make a deal. Now I'm feeling too trill, like it isn't real. Whether you in it for the love or the thrill, live life.